In this video, we're going to break down why some investors are preparing to buy the SpaceX IPO on day one, while others are warning that it could become one of the most dangerous investment mistakes of the decade. You'll discover the three major risks hiding beneath the excitement, why valuation may matter more than hype, and what history says happens when investors rush into mega IPOs without understanding what they're really paying for. Few businesses have changed their industries as dramatically as the company we're discussing today. It dominates a critical global market, controls infrastructure that governments and corporations depend on, and sits at the center of several massive long-term trends. Space technology, satellite communications, artificial intelligence, and global connectivity are all expected to become increasingly important over the coming decades. That is exactly why so many investors are paying attention. But great businesses do not automatically make great investments, and that distinction could determine whether investors make money or lose money after the IPO excitement fades. Let's dive in. The upcoming SpaceX IPO is shaping up to be one of the most anticipated public offerings in financial history. For years, ordinary investors watched from the sidelines as private investors captured enormous gains while the company remained unavailable to the public. Now that window is finally opening. SpaceX is expected to begin trading on the Nasdaq on June 12th, with an IPO price around $135 per share. The company plans to issue approximately 555.6 million shares, which would value the business at roughly $1.75 trillion. That number alone is enough to stop investors in their tracks. At a $1.75 trillion valuation, SpaceX would instantly become one of the most valuable publicly traded companies on Earth from the very first day of trading. Think about that for a moment. Most companies spend decades climbing toward trillion-dollar valuations. SpaceX would arrive there immediately. That fact alone creates both opportunity and risk. The opportunity is obvious. This is not a speculative startup trying to prove its business model. SpaceX has already transformed the launch industry. It has built one of the most important satellite internet networks in the world. It has established relationships with governments and major institutions, and it continues expanding into markets that could become significantly larger over time. The risk, however, is that investors may already be paying for years of future success before those future results actually happen. And that brings us to the first major risk. The valuation may already be pricing in perfection. Whenever investors become excited about a company, there is a tendency to focus on what the business could become rather than what the business is today. That mindset can be extremely dangerous. The market is not just evaluating whether a company is great. The market is evaluating whether the stock price accurately reflects that greatness. According to current estimates, SpaceX is coming public at roughly 110 times trailing sales. That is an extraordinarily rich valuation. When investors pay that kind of multiple, they are essentially betting that almost everything goes right. Growth needs to remain strong. Execution needs to remain strong. Demand needs to remain strong. Margins need to improve. Expansion plans need to succeed. And competition cannot become a serious problem. Any disappointment can create pressure on the stock. This is why valuation matters. The higher the expectations, the less room there is for mistakes. Morningstar analyst Nicholas Owens has taken one of the more skeptical positions regarding the IPO. His assessment was straightforward. He described the shares as overvalued in almost any near-term scenario. Even more striking, Morningstar's estimate of fair value sits near $780 billion. Compare that to the proposed IPO valuation of roughly $1.75 trillion. That is less than half the expected public market value. Now, does that mean SpaceX is a bad company? Absolutely not. In fact, many investors would agree that SpaceX is one of the most impressive businesses ever built. Its launch business dominates the private space industry. Its satellite internet network has become a meaningful commercial operation. Its technological achievements are undeniable. But investing success depends on more than admiring the company. It depends on what price you're willing to pay. Imagine purchasing a house. Even if it's the most beautiful house in the neighborhood, paying double its market value would still be a risky decision. The same principle applies to stocks. Many investors become so focused on a company's future that they stop asking whether that future is already reflected in today's price. And that may be exactly what's happening here. Another issue investors need to consider is competition for capital. Public markets have a limited amount of investment dollars. SpaceX is not the only major growth story seeking investor attention. Artificial intelligence continues attracting massive capital flows. Other high-profile companies are also expected to pursue public listings. Investors may eventually face choices. Do they allocate new capital to SpaceX? Or do they allocate that capital elsewhere? That competition for investment dollars could influence demand and valuation after the IPO. The key takeaway is simple. A great company can still be a poor investment if investors pay too much. And at $1.75 trillion, many analysts believe investors are being asked to pay for a future that may take years to fully materialize. But valuation is only the beginning, because the second risk could be even more important. Risk number 2, operational and governance risks, are larger than many investors realize. One reason investors love software businesses is that they can scale rapidly with relatively low costs. SpaceX is not that type of company. Its business operates in some of the most complex industries on Earth: rocket launches, satellite deployments, telecommunications infrastructure, artificial intelligence initiatives, government contracts. Every one of these activities involves significant capital requirements, regulatory oversight, and execution risk. Success is never guaranteed. A launch failure can create headlines around the world. A regulatory setback can delay projects. Changes in government policy can impact contracts. Unexpected technical issues can increase costs. These realities are simply part of operating in industries this complex. And investors should remember that public markets often react quickly when expectations are high. When investors expect perfection, even small setbacks can have an outsized impact on share prices. Then there is the governance issue. This topic receives far less attention than valuation, but it may matter just as much. Elon Musk owns approximately 42% of the company's equity. However, through a dual-class share structure, he reportedly controls roughly 85% of the voting power. That distinction is extremely important. Many investors mistakenly assume that owning shares automatically gives them meaningful influence over corporate decisions. In this case, that influence is limited. Public shareholders would participate economically, but they would have very little ability to influence leadership decisions, board elections, or corporate strategy. In practical terms, investors would be placing a tremendous amount of trust in one individual. Supporters view this as a strength. They argue that visionary founders often create extraordinary value when allowed to focus on long-term execution without constant shareholder interference. Critics view it differently. They argue that concentrated control reduces accountability and increases risk. David Traynor, CEO of New Constructs Research, has publicly advised investors to avoid the IPO. His concerns extend beyond valuation and directly into the governance structure. Similarly, legal experts familiar with public market regulations have expressed concerns regarding the balance of power between management and public shareholders. Whether investors agree or disagree with those criticisms is less important than understanding them, because once you buy the stock, you are effectively accepting that structure. You are agreeing to participate under those rules. That doesn't automatically make the investment wrong, but it does make understanding the governance structure essential. Many investors spend hours researching revenue growth and profit margins. Far fewer spend time studying shareholder rights. Yet governance issues have influenced countless investments throughout market history. The reality is simple. When a company combines a premium valuation with concentrated control, investors need to be especially confident in management's long-term decision-making. And while many investors have tremendous confidence in SpaceX leadership, confidence alone does not eliminate risk. Now let's move to the third and perhaps most overlooked risk of all. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Risk number 3. History suggests that IPO excitement often ends badly for early buyers. This is where things become particularly interesting. Because the biggest threat to investors may not be the business, it may be investor psychology. History is filled with examples of highly anticipated IPOs generating enormous excitement before delivering disappointing returns. Why does this happen? Because enthusiasm often pushes prices higher than fundamentals can immediately justify. When demand surges during an IPO, investors frequently become focused on owning the stock rather than evaluating the price. That emotional behavior can create problems. Research conducted by Jay Ritter, director of the IPO initiative at the University of Florida, provides an important warning. Among IPOs that generated more than $100 million in sales and carried price-to-sales ratios above 40 at their offering price, 12 out of 14 underperformed the broader market during the following 3 years when purchased at the first closing price. Think about that statistic carefully. These were not weak businesses. These were companies that entered the public markets with strong growth stories and high investor expectations. Yet most failed to outperform. Why? Because expectations were already extremely high, and high expectations are difficult to exceed. SpaceX enters the market at a valuation multiple even richer than many of those historical examples. That doesn't guarantee underperformance, but it does increase the importance of investor discipline. Then there's another statistic investors should understand. Research from Truist indicates that major IPOs have experienced average maximum first-year drawdowns of approximately 55%. That means even successful companies often see significant declines after going public. Imagine buying on day one. Imagine watching the stock fall 30%, 40%, or even 50% despite the long-term business remaining intact. Many investors underestimate how psychologically difficult that experience can be. This is why first-day gains can be misleading. A stock can surge immediately after an IPO and still become a disappointing investment later. Short-term excitement and long-term returns are not the same thing. And this brings us to another issue that growth investors may struggle with. For decades, some of the biggest investment winners began as relatively small public companies. Early investors benefited from years of expansion as those businesses scaled. SpaceX enters public markets in a completely different position. At roughly $1.75 trillion, investors are not buying a small company with unlimited room to grow. They are buying one of the largest companies in the world. Could the stock still generate strong returns? Absolutely. But expectations must be realistic. To become one of the world's largest companies, SpaceX has already completed much of the journey that many growth investors typically hope to capture. The private market enjoyed a large portion of that value creation. Public investors are arriving much later in the story. That does not eliminate opportunity, it simply changes the mathematics. Investors hoping for the next life-changing early-stage growth story may discover that SpaceX no longer fits that profile. Instead, it may be transitioning into a different type of investment entirely. One where execution, valuation, and long-term cash generation matter even more than explosive early growth. So should investors avoid SpaceX altogether? Not necessarily. SpaceX remains one of the most remarkable businesses ever created. Its leadership position in launches, satellite communications, and emerging technologies gives it tremendous long-term potential. The company could continue creating substantial shareholder value over time. But smart investors separate admiration from analysis. They understand that even extraordinary companies come with risks, and when a stock begins its public life at a $1.75 trillion valuation, those risks deserve serious attention. The three biggest concerns are clear. First, investors may be paying a valuation that already assumes years of future success. Second, operational complexity and concentrated voting control create risks many investors overlook. Third, history suggests that buying highly anticipated IPOs at peak excitement often leads to disappointing returns, even when the underlying business remains strong. The smartest investors are not asking whether SpaceX is a great company. They are asking whether the current price leaves enough room for attractive future returns, and that may be the most important question of all. Before you make any decision about participating in the SpaceX IPO, there is one final perspective worth considering. The market often rewards patience. That may sound simple, but it is one of the hardest investing lessons to follow when excitement reaches extreme levels. When a company captures the public imagination, investors naturally begin picturing all the ways the future could unfold. They imagine expanding markets, new technologies, stronger earnings, and years of growth ahead. And to be fair, SpaceX has plenty of reasons to inspire that kind of optimism. The company remains a dominant force in private space launches. Its satellite internet network continues expanding globally. Its technology platform gives it opportunities across multiple industries, and its leadership position in innovation remains difficult to challenge. Those are all legitimate strengths. But successful investing is not about identifying companies that everyone agrees are great. It is about determining whether the expected future is already reflected in the stock price. That is why some of the best investors in history spend more time thinking about risk than reward. They know that protecting capital is often just as important as growing it. In the case of SpaceX, investors are facing a unique situation. On one hand, they are looking at one of the most influential businesses ever created. On the other hand, they are looking at a company that is entering public markets at roughly $1.75 trillion. That combination creates both excitement and uncertainty. If the company executes exceptionally well for years to come, today's valuation may eventually look reasonable. But if growth slows, if expectations prove too aggressive, or if investor enthusiasm cools, the stock could experience significant volatility along the way. And that is where expectations become critical. Investors hoping to double or triple their money quickly may be setting themselves up for disappointment. The reality is that larger companies often require substantially more growth in absolute dollars to generate the same percentage returns investors enjoyed during earlier stages of development. That does not mean strong returns are impossible. It simply means the path may look very different from what many investors expect. The most important takeaway from this video is not that SpaceX is a bad investment. The most important takeaway is that investors should understand exactly what they are buying and exactly what risks they are accepting. Because when excitement dominates the conversation, risk often gets pushed into the background, and that is usually when mistakes happen. The investors who ultimately succeed are often the ones willing to ask difficult questions while everyone else is focused on easy answers. Is the valuation reasonable? Are expectations realistic? Does the governance structure align with shareholder interests? How much downside risk exists if the market becomes less optimistic? And perhaps most importantly, does the potential reward justify the risks being taken? Those questions matter far more than the opening day headlines. Because years from now, investors will not remember the excitement surrounding the IPO. They will remember the returns. And those returns will depend on fundamentals, execution, and valuation, not hype. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. As always, investing is a game of probabilities, not certainties. Nobody knows exactly how the SpaceX IPO will perform over the next month, the next year, or the next decade. But understanding the risks before you invest gives you a significant advantage over investors who simply follow the crowd. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Do you believe SpaceX's dominance in space launches and satellite internet justifies its massive IPO valuation, or do you think the risks outweigh the potential rewards at current prices? Let me know in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.